Welcome everybody, I'm Raghee Horner and this is the Forex in 5 full-time strategies for part-time traders presentation, part 1 of 2. Thanks for joining me here, and big thanks to you for making it to this live presentation. We're going to go over a lot of concepts here today. We're going to cover charts, not only obviously in the Forex market, but related charts in the futures market. And I'm particularly excited to be talking today because I'm gearing up for the release of my third book here in about 5-6 months, which seems like a long time away, but it'll be here before you know it. And what's funny is I'm doing this presentation here with you basically the day after my deadline for the text was due. So all the information that was in my head and all the information that went into the book is really fresh. So I'm really excited to be talking to you about all this stuff, because I think one of the things that a lot of traders feel that they're looking to become is a full-time trader. And I'll be the first one to tell you that's not what I'm looking to do, and that's not what I am. My job, my role as a trader is not one that I think is best served if I'm in front of my computer for 8-10 hours a day. Tried it, hated it, totally broke down trying to do that and keep up that type of pace. And I'm here to tell you is there's a difference between being smart and being wise. Smart is learning from your own mistakes, and wise is learning from the mistakes of others. So obviously I'm hoping you're going to be the latter. I'm going to share with you how I came across this, and we're going to get into some really detailed strategies. If you've ever seen my online or live presentations before, you know I like working from live charts. I'm not one to usually hide behind a PowerPoint, not my favorite thing in the world, but if there are notes that I want you to be aware of, I will type them right on the chart. Okay? And you guys can make notes of your own on your own. And I do encourage you to listen actively, which means sit down with pen and paper, take notes. Let me give you a few contact information, some links here right off the bat that you can check out. And I'll be giving you some other links as we go along here, the presentation. But I do encourage you to check out my Chartology blog here at FX Street, and I believe that link was put up here already, but I'll be more than happy to. I just want to type it up on here on the video. So if you go to blogs, don't want to change the symbol. Let's try that again, shall we? All right. So if you want to go to blogs.fxstreet.com/Chartology. There we go. That will take you to the Chartology blog at FX Street, where I put video and commentary and updates and things of that nature. Of course, you can post your questions and comments there as well. Okay. I also have a personal blog that I do, and that's not just Forex oriented, but just trading thoughts in general, market thoughts in general. And that's at RagheeHorner.com. And like I said, I'll be giving you guys other links and sites to refer back to as we go along. All right, so we've got about 90 minutes here together. We'll probably take a break after the first, say, 40 or so, and we'll take questions as well. And then we'll move on to part 2. But part 1 is going to be pretty chock full. Let's just, I was given some great advice a long time ago when I was first getting into some public speaking. And that was basically, when you're public speaking, you should tell people what you're going to tell them, and then tell them again. Okay? And so repetition is definitely the best way that I can get a concept through to you until it clicks. So let's talk about what I'm going to talk about today. This market never sleeps, we know that. And while it's definitely an asset in terms of order execution and trade opportunity, just a number of trade opportunities, there's also a challenge. And the challenge is walking away. Okay? Walking away from the Forex can be very difficult. Even more difficult can be knowing when you're supposed to be trading, when you're supposed to be active. And that will be part of what we will talk about today. What are the best trading hours? What are the times we should be looking for opportunities? But since all of us have different schedules and different lives, we all quite possibly is an international room here. We probably have people from all over the globe here today. The different schedules. How do we fit Forex into making sure we're focusing on the largest and most influential financial centers without inadvertently wandering into the doldrums? And there are doldrums in those 24-hour periods. There are times where I think it's less effective to trade, and sometimes where you really shouldn't enter new trades at all. Okay? There's some simple tools I'm going to teach you. Nothing is proprietary. You don't need anything other than a good, decent, good, robust charting platform. I use eSignal, but certainly if you use MT4 or any of your brokers' platforms, as long as you can put some what I think are pretty basic indicators up on your charts, you'll be fine. Okay? These are not sophisticated tools. They're powerful. Okay? They're simple, but complex is not necessarily better. Okay? So we will also discuss how non-forex markets, and by that I mean my Forex Market Pulse. Maybe some of you have seen me talk about that before. But we'll talk about how non-forex markets can give you tremendous insight into what's going on in the pairs. Now, let me give you a little background on how I do this, because the main point here is how do you fit the Forex into your life and not let it become your life? I can't tell you how many people I talk to that are just borderline, trading addicts. They need a support group or something. They don't know when to walk away. I was that person once upon a time, and I think I've gotten much better. And as I've gotten better, I found, at walking away, I find that what Las Vegas knows is something that we should know, and it applies to the Forex market. Think about it for a moment. I'm going to talk about the Las Vegas analogy here, because I think it's at the heart of what it means to be a Forex and 5 trader. Las Vegas knows if they can keep you there, okay, if they can get you in that casino and keep you there, chances are they're going to take every dime you've got and then some. Okay, that's why they've got the entertainment and the drinks and and no clocks on the wall and no windows or anything like that. Lose track of time, sit down in those casinos and just gamble away. They understand that time is on their side. They can take small losses for a long period of time because they're very well capitalized. And they know, again, time is on their side. If you stay, they'll get you. And we all know that to be true. They don't build $2 billion hotels in the desert because everyone's leaving Las Vegas with pocketfuls of money, right? So can we take that analogy to the Forex market, to the financial markets in general, stocks, futures, Forex? Absolutely. Like anyone who's participating in a game where you're trading against what's likely to be a better capitalized adversary. Now, think about it for a moment. For every buy, there's a sell. Okay, this is not about someone taking the other side of your trade, but just the function of what it means to be a trader. Think about that. For every buy, there's a sell. Okay, you've got to have both. You've got to have both sides of the equation here. So, if someone is selling me when I'm buying, or if I'm buying what somebody else is selling, one of us is bound to be wrong. Okay, so at some point, we need to ask ourselves, when should we stop dealing? When should we stop working with the market? When should we walk away? And that, to me, has always been where most traders fall short. They have plenty of great strategies. They've done their homework. They know what kind of entry strategies they've got. They've got risk management up the wazoo. Okay? But they don't know when to walk away. Again, that's what Forex and 5 is all about, and we will talk about that. And this isn't about the convenience of when we should be trading. That's the worst habit I see most people dictate their trading schedule by. Somehow that convenience is what the Forex market's all about. That's not the case at all. It may be 24 hours, but convenience should have nothing to do with it. When you're home from work, or when you've got a break in the day, or before you head off to the office, or between the kids, going to school, whatever the reasoning may be, that's secondary to when you should be trading. When you could be trading is one thing. When you should be trading is another. So don't make Forex, the 24 hours of the Forex market, convenience in terms of when you trade. Because most often than not, the convenient time is not necessarily going to be the best time. And I've got some statistical graphs that I'll show you that will give you a rather large sampling of the different volatility times, the different liquidity times as we go across the financial centers. Now let's talk about the financial centers here. And this might be rudimentary for some of you, but I think sometimes it's the things that we forget that often can make the biggest difference. So let's talk about the financial centers. We're going to talk a little bit about market overlap here and start talking about when we should be trading. And then we'll get into the how. The how is pretty simple. I got to tell you guys, trading is not difficult. It's not difficult at all. This is not a particularly difficult endeavor. What is hard, though, is dealing with inner psychology, internal psychology, our own mind, and then also at the same time trying to interpret the cryptic messages of market psychology. Okay? So it's not enough just to read books about how you can optimize your own trading psychology. Okay? That's all good and well, and I think for the most part, most of us know what those good habits are. Okay? That self-talk that we put ourselves through. I think where most people begin to get lost is when they're trying to determine market psychology. And the way we determine market psychology, by the way, is for us, for our purposes here, for the next few hours, is price. I'll talk about news and its place within your analysis, but the main thing we're going to do to measure market psychology is price. And if you're a fundamental trader, don't worry, I'm not talking about dismissing fundamentals. And if you're a technical trader or a chartist, like I am, I'm going to teach you how to use fundamentals and the psychology of that to improve your trading. I think that the best traders are in many ways a hybrid, not a 50-50 hybrid, but a hybrid where I think ideally maybe 10% of what you do should come from some sort of fundamental analysis and 90% should come from price. Okay? But ignoring that 10% of fundamentals could be very, one, ignorant, and two, costly. All right? So again, we talked about convenience here. Most people find themselves trading, and I know here in the States, most people find themselves trading during the Asian session. Well, in terms of your major financial centers, now I say major because there's more than these financial centers, obviously, but these are the major ones. So starting with where the sun rises every single day, Sydney. Sydney really, in and of itself, and I have nothing against Sydney in Australia, it's a beautiful country, but it's not a major financial center for any other reason than it's the first look at a brand new day. It's not an issue of lack of importance, but really I think it's a lack of participation, a lack of volume. There's not a lot of turnover out of Sydney. But again, it is the first look at a brand new day. So following Sydney, we get over into Tokyo. And this is where, I think you really start getting some serious market participation with Japan, with Tokyo. That, to me, that overlap between Sydney and Tokyo is really the open of a fresh day in Forex. Sydney alone might give me a little insight, but it's Tokyo joining the party that really make the Asian session, start to rock. When the Asian session's at full bore, you're going to have Singapore and you're going to have Hong Kong join the party. Okay, and I put them together not because, they're in the same time zone, not because they're the same financial center, but because they're in the same time zone. So I've got Singapore and I've got Hong Kong that really round out that Asian session. When all those markets are open, you've got an active, full tilt Asian session going. Now, the Asian session in general, generally speaking, is only about, 10% of daily turnover. And I'm just rounding out here. You can go to the Bank of International Settlements. I believe it's BIS.org. But I'm just here to tell you that it's about 10% of daily turnover. It's not a significant amount. Could that figure change? Sure. I'm not going to just fixate and say 10% forever and ever. As China grows into a bigger and bigger financial power, depending upon what's happening in the world, obviously that number can change. And, if you check this thing quarterly, you should be fine in terms of where the participation is coming from. But right now, for our purposes here today, about 10% of daily turnover comes from the Asian session. Okay, so now we start to, go around the globe, and here comes Frankfurt and London. Now, London is the 800-pound gorilla. Okay, Frankfurt starts the European session, and then London is your 800-pound gorilla. Now, in terms of daily turnover, you're talking about close to 40% coming out of Europe. So I'm throwing these percentages out there because they're applicable. I want you to understand that if you habitually trade Asia, you're trading a very minor opinion, 10% participation, 10%, I should say, turnover. That's a very minor amount of opinion coming out of that session. You start working into Europe and the UK, Frankfurt and London, now you're talking 40%. More opinion, more weight, more importance. Okay, so trading the opinion of Asia, and that's fine, you can do that. It's not as if the markets don't move during the Asian session, they certainly do. But when you get into Frankfurt, when you get into that open, the European Open, remember, whatever opinion might have been held in Asia, once Frankfurt opens, it's got the choice and the power to either completely reverse it or continue it. So in a sense, you've got the overall market basically having daily, what I'll call, psychological hot zones. In other words, when each one of these financial centers open, especially when you make the transition from Asia to Europe, you're going to get, in essence, a psychological shift from a smaller financial center or financial, the Asian session, smaller financial session, to the largest one. You're going from basically smallest to largest at 2 a.m. Eastern. Okay, I live on the East Coast, and I'm definitely not a human time zone calculator. So I live in Florida, so I think in East Coast, and I'm probably going to talk to y'all in East Coast time. So, and just so you know, East Coast to GMT, it's a 5-hour difference. So GMT is what, about 20 after 2 right now? 20 after 2 in the afternoon? 14:20 or 2:20 in the afternoon? Right now, just for reference, it's 9:20 in the morning on the East Coast. Okay? So, again, I apologize. I think in East Coast, and even if I try to translate, I will eventually slip back into East Coast thinking. So, 14:20 in the UK, thank you, Mike. It's 9:20 here on the East Coast of the U.S. Okay? So, definitely, I apologize. I realize, we're an international room here, but that's where my brain's at. That's where my brain and my body's at. That's where I'm at, period, okay? So, 800-pound gorilla of London, 5-hour difference. All right? So, finally, we get to New York. And in terms of ranking, if you're talking about the Asian session to the European and UK session, to finally to the U.S. session, U.S. ranks second, somewhere around 18 to 20%. So Tokyo, as I mentioned, was about 10%. Frankfurt and London was about 40%. That's 50% of daily turnover right there. And then you get into the U.S., which is about 20%. Now that's 70% of daily turnover. As I mentioned, this is not the culmination of all the financial centers. These are just the big three. Okay, US, Europe, Asia. Europe being the biggest, Europe and UK. So that's about 70% of daily turnover, roughly. Obviously, there are other financial centers. Obviously, there are other somewhat impactful countries, but those cumulatively only make up about the rest of 30% there. Okay, so we're basically moving from Asia to Europe to US every single day with a couple spatterings of other smaller countries and participation involved. So now I want you to ask yourself here real quick, when do I habitually enter trades? When do you habitually enter trades? It's a really important question to ask yourself. Okay? When are you habitually entering your trades? I'm not saying trading. I'm not talking about trade management. I'm not talking about exit. I'm talking about you ask yourself right now, when am I typically putting my trades into the market? I don't know when that is, but you need to ask yourself right now, and then you need to go back and ask yourself, whose opinion am I trading with? Am I noticing that I might be getting stopped out in between the transitions from one major financial center to the next? You know, are you finding that as you go from, say, Sydney to Tokyo, that you're noticing that there might be an acceleration or a shift? Tokyo to Singapore and Hong Kong, not so much. And realize there's only a 1 hour difference between the Sydney Open, the Tokyo, and then the Singapore and Hong Kong. Now, I also have to mention that is it really any such thing as an open or really a close for that matter? Do the markets really do that? Well, not in the Forex market, but I keep referring to opens and closes, right? Well, for me, for my purposes here, obviously we have to artificially talk about opens and closes. It's an artificial discussion because there really is no such thing, is there, except for Sunday and Friday, you know, Sunday open, Friday close. So when we're talking about the artificial open and close, each financial center, you know, these are just human beings, my friends, and we all more or less work a very typical day. I don't care if you're in Tokyo, I don't care if you're in London, I don't care if you're in New York. We all more or less work about 8 to 5 every day. That's just what human beings have found themselves doing in financial center after financial center and in city after city, about 8 to 5. If you want to make that about 7 a.m., whatever the time zone may be, 7 a.m. in Tokyo, 7 a.m. in London, 7 a.m. in New York, about 7 a.m. to about 5 p.m. That's what a basically daily work schedule looks like anywhere in the world. So when I'm talking about opens and closes in Tokyo, I'm talking about 7 a.m. to 5 p.m. Tokyo time. If I'm talking about New York or London, I'm talking roughly 7 a.m. to 5 p.m. in those respective cities. Now, it's not like there's a bell that rings like the New York Stock Exchange. It's not like we have some sort of visual or audible open. This is off exchange. There is no exchange, is there? So while the stock market might open like a horse race, you know, the bell goes and then they're off. While the commodities markets also operate that way. The pit's open and everyone's, here comes this big pouring in of volume because the market's been closed and everybody pours on in. That does not happen in the Forex market. Okay? It does not happen here. So it's more like a freight trade. So futures and stocks are like a horse race. The starting gun goes off and then everybody pours, starts pouring in their orders. It's more like a freight train in the case of the Forex. And what do I mean by that? Forex is a freight train. Well, if any of you watch a train start, it starts off very slowly. It gets started and it's rolling along until it hits top speed. It takes some time to get going. I think the Forex market's very much that way because think about what happens as one financial center closes and another one opens. You've got one kind of rolling down. Let's use the transition from the Asian close to the European and the UK open. 4 a.m. Eastern Standard Time is roughly when people consider the Asian markets to be closing. So that market winds down to a halt, but then at the same time, simultaneously, you've got this European and UK session getting busy. The reason I say 7 a.m. is not that I think that all the traders are in their office 7 a.m. and working at that point, but between 7 and 8 a.m., they gear up. That's what happens here in the U.S. Between 7 and 8 a.m., the day starts to begin. There's not that many people in the office at 7, but there are some. And as you get closer and closer to 8 a.m., it's like that freight train starting. Now realize that at 7 a.m., 8 a.m. New York time, that's basically about lunchtime in the UK. So while we're getting going here on the East Coast of the U.S., that's more or less lunchtime in the UK. Don't forget that these are people. They have to eat and they have to sleep, and eventually they're going to go home. That's the rhythm of the market. That's why the 24-hour nature of the Forex market, you have to dissect it and understand which hours people are doing what. I think that's something that often gets lost when people start talking about a 24-hour market. Now, if you're coming from a background of stocks and futures, you already know this. Okay, you already know this. You know that if you're a stock trader or a futures trader, you understand opens, you understand closes, you understand lunch. You know, I still do quite a bit of stock trading, and sometimes I'll day trade even. I'm not a day trader. I believe that, you know, some strategies just happen to be short-term in nature, but if I'm trading intraday, I know the 9:30 open Eastern Standard Time gets the stock market going, and that there's a 30-minute clearing till about 10 o'clock. I know there's going to be lunch basically between, 12 and 2. I know that the momentum coming out of 2 o'clock Eastern Standard Time going into the 3 o'clock bond close is going to definitely give a certain amount of influence to the eventual close of the stock market. I know that where the market is at 3 o'clock and at the bond close is usually going to be accelerated directionally into the 4. Time matters. Okay? And that same kind of rhythm can be placed on the Forex market. And that's why I'm spending time here on this topic. That's the first thing you have to consider, time. Okay, and I think more than any other type of trader, we have to understand time. Who's winding down their day? Who's starting up their day? Okay? Now, there are some times when you should not trade. Now, when I say trade, I should be a little bit more specific. You should not place new entries. And to me, those times you should not place new entries are between noon Eastern Standard Time, which is what? 5 p.m. GMT, and basically the Sydney Open. And preferably the Sydney and the Tokyo overlap. So in between that, I don't think you should trade. Enter new trades. Now, if you've got an existing trade open and you're managing it, that's fine. That's fine. If you've got a stop loss that gets hit or a profit target that gets hit, you likely already have a stop order or a limit order parked in the market, and it's going to take care of that for you. At least I hope you would. Okay? But between noon Eastern Standard Time, which is, again, 5 p.m., well, what's happening at 5 p.m.? London's closing. Frankfurt, by the way, closed about an hour before that. Close again, artificially meaning people have to go home, right? So they closed. And then as you approach the afternoon here in the U.S., what happens? What's the phenomenon that happens? There is no other major financial center open other than New York until Sydney opens. That's the trick. Now, right now in Tokyo, it's 11:30 p.m. So I'm still 7.5 hours from Tokyo even thinking about getting geared up for the day. That means right now I'm still about 6.5 hours from Sydney getting geared up for the day. 6.5 hours from now basically puts me, 9:30 right now? Basically puts me at 4 p.m. Okay, so around 4 p.m., 4:30 p.m. Actually, no, I'm sorry. It was at 4:30 p.m., 4:35 p.m. So When Sydney gets going here, I'm looking at the fresh new day. When Tokyo comes to the party, I'm looking at a much more complete Asian session. And then when Singapore and Hong Kong come in, I'm looking at the complete Asian session. That's all going to start about 6.5 hours from now with Sydney. All right, so again, understand where the financial centers are at, who's awake, who's participating in the moves, and when they're going to get active again. And if you haven't done that yet, if you haven't determined when you're habitually trading, when you're, and eventually what I'd like you to do is when you do enter a trade, put the time down. And even better, make a note as to which financial centers are open. I'm telling you, if you do this for the better part of about a month, you will notice that certain times your trading is just better. And chances are you're going to notice that it has to do with when the major financial centers are overlapping. Okay, what about me? When do I trade? My personal active trading hours. For me, being on the East Coast of the U.S., and I'm going to tell you why this is important too. Just a moment. Being here on the East Coast of the U.S., my basic active trading hours are 7 a.m. to noon. I trade the London, well actually the Frankfurt, London, and New York overlap, the market overlap. When London closes for the day with that 800-pound gorilla goes home for the day, so do I. Until I choose that I decide I want to trade Asia. This is not a small thing here, gang. Time is a huge consideration. Before you get the price, before you get the strategies, there are some foundations. Usually, if you're struggling as a trader right now, it probably has less to do with your actual methodology and when you're applying it. When has two considerations. We're going to talk about that here in just a moment, but let me just say, when has two considerations. Time-wise when you're trading and market cycle-wise when you're trading. Okay, those are the two considerations. We'll talk about that in just a moment. So that's when I personally trade, that Frankfurt, London, New York market overlap. Okay? So what does Vegas know that we as traders can learn from? You have to learn to pick and choose your spots. Vegas knows they're going to take every roll of the dice, every flip of the card, every single bet, call it trade, out there Vegas is going to take, knowing that if they hang in there long enough, eventually they're going to win. I'm not capitalized like Vegas, and my guess is neither are you. And that's okay. But that means I have to pick and choose when I play. I can't be at this all the time. I'm going to lose. I'm going to lose against a better, more capitalized, pretty much insurmountable opponent. And that's okay. I don't need to beat Vegas to walk out a winner. I don't need to own the casino. I just need to know when I should be playing, and more importantly, when I should not be playing. Now, there are certain things I can put on my side. Statistically speaking, things move in momentum. And that's part of why market cycle analysis is so important. So let's transition there and talk about market cycle analysis. Okay? And by the way, if you have questions, go ahead and type them in. If they're on topic, I'll go ahead to, contribute to where we are right now in the topic. I'll go ahead and tackle them. And if not, we'll come back and do a Q&A before we wrap up our session here. All right. So I'm not telling you when you should trade, but I want you to consider when you are trading. Now, the when, as I mentioned, had two factors. When in terms of time and in the financial center overlaps, and when in terms of market cycle analysis. Again, whatever strategy you're using, these two things I'm talking about right now are going to, number one, allow you to trade or be in front of your computer less, which is something I'm all for. I didn't become a trader to be, chained to my computer. That wasn't it at all. I trade for freedom. I trade because I love going and having a 2-hour lunch with my husband or best friend or my mom. I love because I like going fishing in the afternoon or golfing with a friend. Okay? There's a life I like to lead, and Forex allows me to do that. But the only reason I can do that is I've learned to manage time. I know when to leave Vegas and I know when to play. And you guys could know that too. That's what we're talking about right now. Okay? So if you want to trade a particular financial center, understand when they open. Again, about 7 a.m. to 5 p.m. in each financial center. The more overlap you have, the more participation you have, the more meaningful the opinion is. Okay, everyone with me there? Okay. So again, it's not a matter of one is better. I just want you to understand size. And again, size-wise, London's the biggest. You know, that London, Frankfurt, European, UK combination, 40%, followed by New York, about 20%. And then a distant third is the Asian. And really, the size of London is basically twice that of New York, and the size of New York is twice that of the Asian session. So you're getting a really big drop-off when you're going from first to second to third in terms of these major financial centers. Okay, it's not a small drop. By and large, the Asian session trades only about a quarter of what the European UK session does. I mean, it's significant. Okay, why are there big moves between 2 and 4 a.m.? Great question, and it's something you guys I'm sure notice. I don't get up at 2 a.m. Eastern Standard Time, which is what 7 a.m. in London, 8 a.m. in Frankfurt. I don't get up then, one, because I love to sleep. I'll be honest with you. I love to sleep. It's just not practical. I think my husband would kill me if I got up and woke the whole house up at 2 in the morning. And by the way, I have tried. I just can't function at that hour. I just cannot function at that hour. And nor should I have to, and nor do I have to. 2 a.m. to 4 a.m. is an interesting time, and if you are in a part of the world, I've got a lot of students in Europe and Asia, and it's realistic for them. Fantastic. If you're up at that part of the day, think about what you're trading. You're trading the last 2 hours of Asia. You're trading the Frankfurt Open, the psychology that comes with this flood of European activity. You're trading the London Open, and there's certainly going to be opinion there. It's the 800-pound gorilla. Okay? But, before y'all decide to move to London, and by the way, I would live in London in a heartbeat. I love London. Love, love, love the city. Absolutely. But before y'all start packing your bags and figuring out, your move to London, we're going to talk a little bit about why New York is so important. And it's not because I'm here on the East Coast. Okay? It's not because I'm here on the East Coast, but I have to tell you, 2 a.m. to 4 a.m., and when we look at these statistical charts I'm going to show you, 2 a.m. to 4 a.m. is representative of one part of the market, but it doesn't factor in the U.S. dollar completely, nor does it factor in U.S. news and economic data. And that's why it's really important to understand that even though London is the biggest, there's one thing that every single heavily traded pair, the majors and the COMDOLs, have in common. There's one thing that the Euro-US dollar, the cable, the dollar yen, the dollar Swissy, the dollar Canada, the Aussie, the Kiwi, those 7, I'm sure you guys would agree with me, are basically your major pairs. Major dollar correlated and your COMDOLs. Those 7 pairs have one thing in common, and that's the U.S. dollar, which is why that New York session, that U.S. session, becomes important no matter which one of those 7 you are trading. We'll get to that, though. I'm getting a little ahead of myself. So let's talk about the when of market cycles. Okay? Because, again, these 2 concepts, time and market cycles, these generally can apply to anything you're doing right now. Everyone here in the room, we probably have slightly different ways of entering the market. We probably have slightly different strategies. And that's great. That's fine. That's what makes the world go round. But there are certain general skills that if you apply to the market, an observation of time and an observation of market cycles will make your current trading that much better. So this has nothing to do with my specific entry strategies, which we will talk about here momentarily. But this has to do with what the basic foundation is for all entry strategies. And this won't take very long at all. Let's go ahead and take a look at this right now. So, market cycles. And why aren't these things discussed more often? I don't know. Well, I actually do. There's been no way to measure these. Let's talk about what they are. Market cycles. This is nothing I've invented or come up with. This is absolutely due to the fact that when I first started trading, the books that I read and the articles and the people who influenced me as a trader and continue to this day all traded in the early 1900s. I'm sure many of you have heard the stories. When I first started trading, we didn't have these super bookstores like we do now. There was no internet to speak of, not in the way we know it now. So the books that I could get my hands on were reprints of books or collections of articles by the likes of Richard Schabacker and Charles Dow and even Richard Wyckoff. And all these men were active in what? The early 1900s, before computers, before much of the regulation we see here now, before systems, before any of this. These guys traded price, and if they had to calculate something, they did it by hand. They mapped their charts out. So these three people, these three men, influenced me more than anything. Schabacker, Charles Dow, and also Richard Wyckoff. More so than anything, though, Charles Dow and Richard Wyckoff. By the way, yes, there are plenty of people who have rewritten books on technical analysis and talked about them, including myself. But I'm here to tell you right now, anyone, and I'm not trying to put anybody down, so I'm not going to mention names, but anybody who talks about technical analysis is basically rewriting Richard Wyckoff's stuff. I'm sorry, Richard Schabacker's stuff. And let me write his name down here in the book that I'm talking about. Richard Schabacker. And the book I'm talking about is called Technical Analysis and Stock Market Profits. There we go. You can pick it up at Amazon. You can pick it up wherever. Anyone who's written any book since this book was printed is just rewriting what he wrote, period. Okay? And when you read it, you'll see what I mean. He came out first, and it was reading Schabacker that I actually fell in love with charting and price, not with indicators. Because remember, these people didn't calculate indicators. I'm not an indicator-heavy trader. Price action, because that's what these guys did. You look at these old books, a lot of price action discussion, trend line, support, resistance, the psychology of the market as it relates and can be measured with price. Okay? Now, the other thing I encourage everyone to do, and this is where the market cycle analysis discussion will come from, which is 100% Charles Dow. I got to give credit where credit's due. There's very seldom something brand new in the market in terms of interpretation or analysis. Charles Dow, that's where you get a lot of your understanding of market cycles. If you guys haven't read Charles Dow's writing, it's a little unusual because obviously it's written in the English language as it was spoke of and written in the early 1900s. It's kind of got a eloquence to it. All right, but and some of the words certainly meant something. That the connotations were different back then. Okay, but these two men are the fathers of technical analysis. Well, Richard Schabacker is the father of technical analysis. Charles Dow is where you really start to see the first time market cycle discussion, the psychology being put forth. I think he was the first one to do it. I don't know if anybody did it before him, or at least publicly. 1900s. So what I'm talking about here is price action, and what I'm talking about here are time-tested. These are almost a century old. Okay, these concepts that we're going to share right now. Okay, all right. So I see that, I see the text window here. There's a couple of questions about other people who have written books. I'm telling you right now, and there's a few names. Again, I don't want to be disrespectful, so I'm not going to put them out there. But let's see, Fanzani. I'm sorry if I butcher this. Fanziano. There we go. And Mario. Both those books are just rewrites of Schabacher. Fanziano, that book actually was written by a nephew of Schabacher. Believe it or not, it was two people who wrote the book you're talking about. They're actually, one of them was a nephew of Richard Schabacher. Okay, so all those are perfectly good, but what's really funny to me is everyone's forgotten about Schabacher and given those gentlemen props for, credit for this, and that's just not the case. They just rewrote what he did. I'm sure they added their own touch, which is certainly probably the case, but I got to give credit where credit is due. Schabacher and Dow. Let's talk about some market cycles here. It's 4 cycles to the market. Okay? Accumulation. Distribution. Mark up. Mark down. 4 cycles. Okay? So when you and by the way, gang, this is not some sort of open-ended discussion of all the different technical analysis traders and contributors out there. Okay? What I'm talking about specifically are market cycles and technical analysis, or I should say charting analysis as we know it. There are plenty of other great teachers and strategies out there, but I'm not talking about particular strategies right now. I'm talking about the foundation from which all the other strategies come. Okay, so we don't need to bring up every single author and every single trader who ever existed to compare their contributions to the market. Okay, there are plenty of other good strategies out there, but what I'm talking about is the foundation that comes before all this. Okay, so accumulation, distribution, mark up, mark down. Those are the 4 cycles, and I've got them on the chart here right now. You should be able to see them there. Let's talk about them one at a time. This is not complicated, gang, because the market can only move up, down, or sideways. So it's our job to figure out what it's doing. Now, it sounds easier than it really is, because up until now, there really hasn't been a way to do so in real time. Okay, I don't know of any other study, and maybe there are some out there. And I'm not saying this to puff myself up, but if there is another tool out there to do this, I would love to hear about it because I'd love to study it. But I don't know of any other indicator or tool out there other than my wave that can allow you to visually get the representation of what the current market cycle is, transitions between them, and measure the strength of the current market cycle. I know of nothing else other than the wave, which is the 34-period exponential moving average on the high, the low, and the close. I know of nothing else to do it. If you got something, let me know. Would love to see it and do some research on it. Okay? Accumulation is a sideways, quiet, range-bound market cycle. Sideways, okay? Market can only move up, down, or sideways. There's 2 styles of sideways movement, accumulation and distribution. So accumulation is going to be the quieter, more narrow-ranging sideways market. Now realize that these market cycles came from stock market analysis. When Charles Dow discussed market cycles, I don't know if he gave them these names in particular, okay? But when he talked about market cycles, remember he was talking about it particular to the stock market, which obviously has a bullish bias. We don't carry that bullish bias into the forex market, okay? But any kind of market like futures and stocks where people by and large look for an increase in value has a bullish bias. So that's why I say stocks and futures have that. Forex, of course, does not. So accumulation was typically that market cycle that came before the big move. It preceded general attention and a run-up. Okay, but you can have accumulation in the forex market at the top of a trend too. The way you're going to know accumulation from distribution is the range will be wider on distribution. It will be more erratic in distribution, and there will not be an evenness of a ceiling or an evenness of a floor typically in distribution. Distribution you'll see probably most often when you look at a good triangle pattern. If you look at a good channel or rectangle pattern, that's typically going to be accumulation. Okay, so these two sideways markets. Now, I'm not talking about drawing trend lines, because usually by the time you draw trend lines, the transition to that market cycle has already happened. I'm talking about real-time, candle-by-candle interpretation of what the market cycle is, the strength of it, and whether it's transitioning or not. And again, the only way I know to do that is with the wave. So if I'm looking at accumulation or distribution, it's the difference between a 3 o'clock wave and a 2 to 4 o'clock wave. And I'm assuming most of you here probably already know what I'm talking about when I talk about clock angles and the wave. If you've ever seen me speak or been to any of the other chats here, you know what they are. Let me just briefly tell you what they are. It's pretty simple. Imagine, if you would, a clock or on your chart. So if I were to put basically 12 o'clock here, 3 o'clock here, and 6 o'clock down here, that's what I'm talking about when I'm referring to clock angles. Before now, trend lines were perceived or angles were perceived by 90 degree or 45 degree, but there's so many other variances in there. And I don't know about you, but I just don't know by sight what 30 degrees looks like or what 20 degrees looks like. I don't know, maybe you do. I know I don't. But there's a familiarity we all know when it comes to clock angles. If I were to tell you to right now close your eyes and envision 2 o'clock, you know what that angle more or less looks like. In fact, we know this so well, and this is something that translates to anybody in any part of the world. You know what 2 o'clock looks like. In fact, you don't even need a watch with numbers on them. They make watches without numbers on them. They make clocks without numbers on them, because we just know, as human beings across the planet, what 1, 2, 3, 4, 5, 6 o'clock looks like, right? So these are angles that we are already very familiar with. So again, the clock angles I'm talking about is 12, 1, 2, 3, 4, 5, 6. This half of the clock, if you will. That's the angles or clock angles I'm talking about. Now, when it comes to wave, had I thought this out, I never thought that when I gave these little indicators names that I'd be writing books and talking to you. I never realized that. If I did, I probably would have given them a better name. And like most people, I probably would have named the thing after myself. So lacking the ego or the foresight to do so, I just call this the wave. Okay? My students will often call it Raghee cycle indicator. I don't care if you call it a bologna sandwich. I call this the wave because I think traders move in and out of the markets in waves. And I like to surf. So there you go. I don't want you to confuse this with Elliott wave or anything like that. It has nothing to do with that. I just call it the wave because, like I said, I probably should have called it the Horner or something or other, right? Now, the wave is basically just 3 moving averages. It is the 34 period, and by the way, 34 is a Fibonacci number, the 34 period exponential moving average on the high. Same thing again, 34 period exponential moving average on the close, and then finally the 34 exponential period moving average on the low. That's what makes these 3 lines up. It's just 3 moving averages. Okay? 34 period, high, low, and close. It's 3 individual moving averages, though. Okay? These Fibonacci-based moving averages allow me to basically take a visual footprint of the direction of the market. Now, some of you might say, well, Raghee, we're looking at this chart of the dollar index, or Raghee, we're looking at this chart of the euro US dollar, the fiber, and I don't need your wave to tell me it's in a downtrend. And you're right. At this stage of a downtrend, you certainly don't need the visual footprint of the wave to do that. No argument there. What I'm talking about, though, and let me use the replay feature here in the e-signal. What I'm talking about, though, is let's go back to, say, late July, early August. This market is sideways, is it not? But is it an accumulation sideways market, or is it a distribution sideways market? If you did not have the wave on this chart, would you be able to determine which it is? I don't know about you, but I probably wouldn't. I probably would not know. I know that there's a range here. I could probably top this range off with a ceiling here and just roughly a floor there, right? But back in this period of time, because the wave was 2 to 4 o'clock, because the wave was more distribution, I was playing ceilings and floors, shorting ceilings, buying floors. As opposed to if the wave was flat at an accumulation angle, where I'd be playing breakout and breakdowns. Realize that anybody could draw these two lines here, okay? The problem with most traders is not identifying support and resistance. This is not difficult. Identifying support and resistance inherently is not difficult. What is difficult, and let me just change the settings here. I like green for support, red for resistance. That's just something I like to do. It's not hard to draw these lines and levels. What's difficult and where most traders get confused is, what do you do at this support? What do you do at this resistance? Do I short support? Do I play the breakout or bounce off support? Do I short this resistance, or do I play the breakout above this resistance? These are just decision levels. Okay? This is just a decision level. Any line or level you draw in a chart is simply a decision level. Okay, that's just basically what these things are. The decision levels. Okay, it's a decision level up here. You have a decision level down here. Yes? Everyone follow me so far? So if I know there's a decision level, what decision am I going to make? Buy or sell? Well, that's the reason why at the same time you might be looking for a short, someone else is looking for a buy. At the same time you're looking to sell the market, someone's willing to buy it. That's why the market moves, because we all have probably, give or take, if you and I were collectively to draw trend lines across any chart, we probably would, give or take, draw more or less the same thing. We'd be looking at the same levels, probably. But what we do at those levels is what makes the difference in the way we trade. Okay? That's the difference, what we do at those levels. Whether you choose to buy or short at this ceiling, whether you choose to buy or short at this floor is what makes the difference. And that's where our trading strategies come into play. What action we take at certain price levels, that's dictated by our trading strategy. But what I'm here to tell you is that your trading strategy should actually be dictated by the market cycle. Let me say that again. Your trading strategy should be dictated by the market cycle. Good old Charles Dow. Okay, so if I've got accumulation and distribution, I want to know which this sideways market is. I look at the 3 lines of the wave, look at the clock angle at which they are traveling at. Uptrends are 12 to 2 o'clock. Take a look back here. This move heading higher. That's an uptrend. All right, that's an uptrend. So uptrends are 12 to 2 o'clock. Downtrends are 4 to 6 o'clock. Sideways markets are either 3 o'clock flat, accumulation, or 2 to 4 o'clock more volatile, distribution. Now, one of the things I mentioned earlier is, how do you determine when this market is transitioning from the sideways to the trend with the wave? Now, most people could look at the wave here and say, oh yeah, that's a downtrend. Okay, you see that? This is the downtrend. But when did you determine that this market started trending lower? Was it this candle? Now, which candle was it when you would finally say to yourself, this market is heading lower? How long would it take? I'm going to tell you right now, my experience from teaching thousands of traders, probably wouldn't have said this was a downtrend until about here. My students probably started determining the downtrend right back about here or here. Well, that's a little bit early, probably about here or here, as the wave turned over and started pointing down. And notice what I'm going to do here to get a good reading on the wave. A couple things here we need to do. And I'm going to backtrack here a little bit. Because if you get this part wrong, if you determine what the angle of the wave is incorrectly, everything else is probably going to be based upon an incorrect assumption of the market direction. So let's backtrack here and talk a little bit about market memory. But what I want you guys to understand here right now is your trading strategy should be dictated by the underlying market environment, by the underlying market cycle. Whether you determine you're going to trend follow, breakout, breakdown, reversal trade, inside the, whatever it is, whatever your strategy is, you need to know what environment it was designed for, because whether you know it or not, that particular strategy, the strategies you have right now at your disposal, the ones you were using before you even came into this chat room here with me, were designed to take advantage of certain types of market environments. Whether you know them or not, that's what you need to go figure out. You go ask the person who taught them to you, go look at the book that you learned them from. At some point, there must be reference to when you use this, because there is no single strategy that works in every market cycle. Doesn't exist. Okay? So it's your job to have a strategy that works in every market cycle. In other words, have one particular to each market cycle. It's your job to have a strategy for an accumulation market, a strategy for a distribution market, a strategy for trending markets, a strategy for reversal of trends. And we'll talk about those four a little bit later on. I need to give you the why and the what for first, though, right? Because unless you know when to apply them, I could throw all four of those strategies out, and it would be just as meaningless as what you might be doing now, because you're going to be applying them completely haphazardly. So my job here over the next few hours is not to change how you're trading, but to have you apply your strategies better. That's the job here. Okay? That's what I'm looking to get you to do. Not rewrite your entire strategy book, but know which one to employ at the right time. Okay? So this is the way the market looked back then. I'm judging the strength or weakness based upon the angle of the wave. How about if I rewind back to about here, where the uptrend was initiating? At what point do I tell myself I'm transitioning from distribution to an uptrend? Where does the wave actually start to tell me that I'm in an uptrend? Okay? So what I hope you're going to see when you start putting the wave on your charts is that you're going to be in tune with the market cycles faster than someone who needs touch points to draw support and resistance and then say, yes, I've got a series of higher lows and thus support for an uptrend. Or yes, draw the touch points and I've got a series of lower highs or the resistance I need for a downtrend. Or yes, I've got the pattern, rectangle or channel or triangle that I need to identify a sideways market. You're gonna recognize the market cycles much quicker than that, because the wave will clue you into it visually much faster. Now, before you go about using wave, and just for no other reason than to change the scenery here, let's go to like a 30-minute chart of the dollar yen, or whatever chart you guys want. I don't care. I don't have any preconceived charts here in mind. So if there's a particular market you want to analyze live, tell me the time frame, tell me the market, and we'll do it. Okay, these are all live charts. I do not like sitting behind the well-chosen charting example. This is all live stuff. Okay, so let me know the pair and the market side, pair and the time frame, and I'll be more than happy to use that for the examples we're doing here. Okay, dollar pound 15 minutes, sure. Or I should say cable. I knew what you meant, though, there, Mike. Okay, so we're taking a look at the cable here. British pound, U.S. dollar. By the way, the relationship back to the U.S. dollar is an inverse one, typically for the British pound. We'll talk about the FX market pulse as well. But take a look here at the 50-minute chart, and what I want to do here is discuss market memory as it pertains to our market cycle reading. Because one thing you've probably already figured out is that depending upon the size of your chart, depending upon the amount of data that you squeeze in on that chart, you can manipulate the clock angle of the wave, right? So it can be kind of subjective. See what I'm doing here? I can absolutely manipulate that line of that wave by squeezing in or squeezing out data. I don't trade off a 15-minute chart all that often, but the market memory for a 15-minute chart, let me just tell you what market memory is. It's the relevant last major moves, touch points, and mood of the market. A 15-minute chart doesn't have a market memory that lasts much more than 3 to 5 days. Once you've kind of gone past 3 to 5 days on a 15-minute chart, the highs, the lows, the moves kind of become a distant memory. So it's psychologically what's relevant for a particular time frame. 3 to 5 days is basically where the 15-minute chart has a certain amount of relevance. And it's within that 3 to 5 day look back that you're going to take a market angle reading or a clock angle reading. It's where you're going to look for highs and lows for any kind of manually drawn trend lines that you might use. It's where you're going to look for last major moves if you're a Fibonacci trader. It's where most of your analysis is going to occur within that relevant amount of price action. Again, 15 minutes, about 3 to 5 days. If I jump out to a 30-minute chart, and by the way, my personal time frames, the ones that I trade from, are the 30, the 60, the 180, the 240, and then finally the daily. Those are the time frames that I typically trade from. Now, if you decide you want to use some of the alternate time frames that I know a lot of people do, 5, 10s, 15s, 120-minute, I know it's a popular one. Some people even tell me they trade from a weekly. I don't trade from these, but these are certainly alternatives that you can consider, and I'll talk about the market memory on those as well. So for 50-minute, I just mentioned it was 3 to 5 days. The same would go for a 10-minute chart, 3 to 5 days. Okay, what about a 5-minute chart? I know some people trade off those. Let me mention something as to why I don't trade off super short-term time frames. And to me, anything below 30 minutes, 15 minutes gets pretty short. There is a cost per trade. It's a cost per trade decision. Okay? And the cost per trade decision has to do with the fact that I'm going to pay the spread. At some point, that cost per trade eats up into the potential upside for very short-term charts. Now, for those of you that do use multiple time frame confirmation, I'm here to say I don't use them. Every one of these time frames that I look at, I treat as a standalone. Because if I'm trading the Euro-US dollar or the cable or the Swissy or the Kiwi or whatever, I realize that the best setup may not be on the same time frame over and over and over again. I know some people love say for example, a 60-minute time frame. They love it. But that does not mean the best trading setup is occurring for that week or for that day, or even for that month in general, on that 60-minute time frame. I'm limiting my view and opportunities of the market if I don't look across multiple time frames, because each one of these time frames could have a very different market cycle. You know, a 60-minute chart is not necessarily reflective of what the daily chart is doing at that given moment. Okay, and certainly the daily chart is not reflective necessarily of what, say, a 120-minute chart is doing. I treat them all separately. And if anything, if you are looking at multiple time frames, it's the smaller bricks of the short-term time frames that build the longer-term time frame. So I'm certainly not going to use a longer-term time frame to analyze or confirm the direction of a short term, because it's in essence 48 30-minute candles that make up a single daily candle. Okay? Or it's 8 3-hour candles that make up a single daily candle. And it's the culmination of these shorter term intraday candles that make up the daily. The only reason the daily chart might be in any kind of market cycle is because the shorter term time frames have persisted in that way long enough. So think of the daily time frame as a wall, and all those intraday time frames as the bricks that build the wall. The wall doesn't come first. The bricks do, right? Which is my argument against multiple time frame confirmation. Multiple time frame confirmation considers the wall first, then the bricks. I don't. I consider the bricks first, making the wall. Everyone clear on that? So let's finish up this discussion of market memory. So for a 30-minute chart, my market memory is basically going to be no less than a week and 2 weeks, typically at most. Okay? 60-minute is the same thing. So on a 30 and 60-minute chart, I'm looking at about 2 weeks of market memory. That's about the relevance of the amount of price action that I need to make decisions. For the 180 and 240, it's about 4 to 6 weeks. 1 month is fine. And the reason I kind of give you guys a little bit of a leeway here in the description isn't because it's not a finite thing. It really isn't. I know that most charting platforms don't give you that exact type of control over how much data you use. If you're on MT4, you might try to squeeze in a month, and it might squeeze in 5 weeks or 3 weeks. On my e-signal, I might try to squeeze in 4 weeks down to the day, but I might, due to last major moves and due to the way e-signal will squeeze in data based upon looking for the last highs and lows, I might get 5 weeks. I might get 4.5 weeks. So it's not an exact thing. You don't have to be that exacting about it. Okay? All right? So on a 180-minute or a 240-minute chart, your look back is going to be about a month. If it goes out to about 6 weeks, that's fine. I have some students that use close to 2 months on a 3 and 4 hour chart, on a 180-minute or 240-minute chart. It's probably, I don't want you erring on an extreme of either side, but if you are going to err to one side or the other, go for more data than less. You're always going to be better off with a little bit more than you will be a little bit less. Okay? On a daily chart, it's 1 year. Okay? 52-week highs and lows, the trend over the year, that matters. So the psychological relevant price data for a daily chart, for an end-of-day chart, is 1 year. So what about these alternate time frames that I don't use? Okay, so we talked about the 5, 10, 15. Oh, actually 5 is about 2 days. 5-minute chart, 2 days. 10 and 15, 3 to 5. The 120, you can set up the way you do your 180 and 240-minute charts with that 4 to 6 week look back. A month to a month and a half, that's fine. The weekly is 5 years. Now, I don't trade off a weekly chart. It's just too much risk to have to assume. Okay? I don't trade off a weekly. But I do like looking at weeklies for significant support and resistance from time to time. So these are the alternates. These are the time frames that I use: 30, 60, 180, 240, and daily. And the reason we talked about these market memory, these look backs, if you will, is because for each time frame, I need to look at that market memory when I'm making a few decisions. One, when I'm making a decision about what the clock angle of the wave is. We talked about the fact that if I expand it out, I can manipulate that wave. It's subjective in that way, visually subjective. So I want to keep my clock angle readings very consistent and within the market memory of that time frame. So for a 30-minute chart, I want roughly 2 weeks. Here you can notice I've got a little bit more, and that's fine. But what I'm trying to determine is what is the angle of this wave right here. Okay, here's about 1 week, which is my minimum. Here's 2 weeks, and you can see it's pointing downward. Would everyone agree that's 4 to 6 o'clock? A little closer to 4, but it's definitely that 4 to 6 o'clock. Would everyone agree here? Yes, you guys see that? So that's the way I'm going to take these clock angles. What if I went out to a daily chart of the cable? No doubt, I'm looking at November to November. No doubt this thing is very steeply heading down. 4 to 6 o'clock? Absolutely. 5 o'clock? Probably. Downtrend. What about the Swissy? Let's take another clock angle reading here. Have we go to like a Swissy 180? Now on a 180-minute chart, what's my look back? 4 to 6 weeks. I'm working within that right now. What's the clock angle here? Would everyone agree it's 12 to 2? It's an uptrend? I've been swing trading the Swissy for the better part of this month because it's been at 12 to 2 o'clock for pretty much the better part of this month. Okay? You don't have to be exact. You don't have to say it's 2 o'clock or 1 o'clock or 3 o'clock. If an uptrend is 12 to 2 in that area, 12 to 2, distribution is 2 to 4. A flat accumulation wave is 3, and a downtrend is 4 to 6. I'll say it one more time. Uptrend is 12 to 2. In that area, distribution is 2 to 4. Accumulation is a flat 3 o'clock, and a downtrend is 4 to 6. This is 12 to 2. You see that right here. It's a 12 to 2 o'clock wave. Now, once we've got all this set, we know what the market memory is that we need to squeeze into our view. By the way, I can't tell you how often I find that the amount of data most people put on their chart is completely random. It's irrelevant to any kind of price action consideration or calendar date consideration, or forget having a relevant market memory. Most people look at their charts based on what they're comfortable with. And what they're comfortable with usually reflects their experience. New traders look at their charts very large because more price action is intimidating. And because they're new and they can't assimilate that much, they look at things very large to keep themselves from overload. Experienced traders kind of go to the other side of the pendulum. They overdo it. They squeeze in too much. Okay? There is a just right. There is a Goldilocks here. And the market memory settings that I gave you for each time frame is the Goldilocks. All right, so now that we know what the market cycles are, now that we know how to measure them with the wave, the 34-period exponential moving average set on the high, one set on the low, one set on the close. It is 34 for every time frame, because realize that 34, any moving average, adjusts with the time frame. Because if I'm looking at a 180-minute chart, it's 34 180-minute candles. If I'm looking at a daily chart, it's 34 daily candles. So it will adjust. I don't change that setting. 34 is a setting for all time frames. Okay. Now that I know what the underlying market cycle is, and now hopefully you can go back to your books and tapes and whatever else you use to learn how to trade and learn the strategies you use, you're going to go back and ask yourself, okay, which market cycle was the strategy that I'm using designed for? Uptrends, downtrends, distribution markets, accumulation markets. It was designed for something. I can promise you that. Whether you know it or not, whether the person who taught it to you knew it or not, it was designed or should be designed for something. There are certain market environments where it probably works really, really well. And if you go back and start to look at your successful trades versus your unsuccessful trades, you'll probably notice that it went down to the whens. The whens meaning when you entered your trade and when you put this in within the context of the market cycle. Remember, these two when considerations, time and market cycle, those two alone could completely make an unbelievably positive change in your trading, because you're using the accuracy of market participation and you're using the accuracy of market cycles to better know when you should be on the floor in Vegas or when you should be leaving. So let's talk about something, and we'll keep up this discussion as we go into the second half of our talk here. Let's talk about the actual entries, because this is pretty simple. Once you've got this homework done, the entries are easy. And like I said, I know every one of you came into this room with certain entries that you currently use. So you don't necessarily need me to tell you how to enter the market. But I'm going to give you the 4 entries that I use, and it's very simple. We'll bang these out here in about 10 minutes. Okay, so let me talk about the Swissy here, because that's what we have on the chart. And we're going to talk about trend following. Okay. Trend following. Trend following is done in the 12 to 2 o'clock or 4 to 6 o'clock market cycle. Because to follow a trend, you actually need a trend. You need to identify one, right? What a concept. You are not your entry strategy. When I meet people, they say, oh, I'm a swing trader. Well, no, you're not really a swing trader. You're a trader who happens to like to look for trends, right? And follow the trends, right? You're not a momentum trader. You just happen to have a strategy that might capitalize on breakouts or breakdowns. So you are not your trading strategy. You trade the Forex market, and you trade the multiple market cycles that are available to you, up, down, or sideways, right? Well, in an uptrending market, you're going to trend follow. Actually, in a downtrending market, you're going to trend follow for that matter as well. So when I have a trend following scenario, 12 to 2 or 4 to 6, this is how easy it is to enter a trend. Now, this is not the only way you can do it. I might have a couple different ways that I like to enter trends, but this is the easiest one. Okay, obviously, I can't distill all my trading strategies and all my knowledge into a brain dump of, 90 minutes, okay, or even 3 hours. But these are the major points, and these are points that I think will make the biggest difference for you. I like to wait for the market to pull back to the support of my wave, okay? Which means that the last time I actually even entered this market was back the end of October. Okay, so I waited for a pullback into the wave. The wave was heading up between 12 and 2, and I played the support of the wave. And it gave me a little bit of worry here the day after I entered, but the validity stayed solid, and I was able to hang on. Before that, I'd gotten in back on the, let's see, this would have been the 10th of October, and what I want you to notice here is all I was looking for were pullbacks to the support of the wave. Boom, and boom. This only can be done within the context of an uptrending wave. And by the way, playing these pullbacks means you've got to be patient. And means that once a market has started to trend, you're not going to get an entry every single day. Heck, you might not get entries for weeks. You have to be patient. Playing a trending market is very difficult because the entries are pretty specific. Now, if you don't want to use the wave, which is very conservative, you can use Fibonacci. You can use psychological numbers. You can use a number of other tools to help you determine where there might be support during a correction, because that's what you're looking to do. Within the context of a trend, up or down, it is your job to identify pullbacks and bounces, and in the context of an uptrend, you buy the pullbacks, and in the context of a downtrend, you short the bounces. That is trend following. That is swing trading. One, identify the trend and use the wave to do it. That's the best and only way I know how to do it, to identify the market cycle. And then two, find those measured pullbacks and bounces and then act accordingly. Okay? All right, so that's trend following. What about on the euro? Because right now that's on a downtrend. You see this downtrend right here? What am I looking for here? I'm looking for bounces, aren't I? And I will short the bounces. Now, I haven't touched the wave, have I? So I've had to use alternate methods of recognizing a bounce or a pullback, a bounce here for this case. That means using psychological numbers. That means using Fibonacci. Okay. Based upon Fibonacci, you guys could probably already see what my last short was on this daily time frame. By the way, this is just a daily time frame, my friends. There are and will continue to be other entry opportunities on other market time frames. Okay, this is just the one that happened on the daily. Okay, so as long as this market cycle is going down between 4 and 6, think about something here. If you are short a market, are you looking to play the opposite direction? No, you just hope that market trends forever. Don't get captured or fall into the pitfall of the psychology of, well, I'm not in the trend, so let me go ahead and play the opposite direction. I will continue to play shorts based upon the euro until the 4 to 6 o'clock market cycle transitions. I'm not looking to buy a bottom. I'm not looking to buy a reversal. These shorts have done me very well. Okay? And I'm going to continue to do that until something changes. That's trend following. Okay? Again, this is just two ways you can recognize support and resistance. In this case, you're looking for shorting resistance, whether it be the resistance of the wave, or in this case, as I showed you here, the resistance of using Fibonacci. All right? Okay, so that's trend following. Pretty simple, right? Because it all gets really simple once you understand which type of strategy to employ in the right market cycle. It gets really easy. I think far too many people spend too much time on individual strategies and not enough time on when they should be using these individual strategies. Seriously. It's a major problem for most traders, to understand that. But once you do, it makes life a whole lot easier. Okay, what about breakout and breakdown trading? Breakout and breakdown trading. All right, so now we need to identify a sideways market. And I'm trying to think of where there might be a sideways market right now that we can look at. Let's take a look at the cable on the 180. That's a market I'm short right now. Okay, so I've got the cable here in a 3-hour chart. What's my market memory here? At least 1 month, which I've got right here. I can go up to 6 weeks if I want. So there's a 1 month look back. So I'm looking at the angle of the wave within the proper look back. Okay, I had drawn an uptrend line, and this uptrend line's been in place for some time, and I had some resistance from some moving averages that I used, which we'll talk about in the second part of our talk here. And this is a classic momentum trade. Number one, it starts with that flat sideways wave. This is an accumulation cycle. Okay, it got a little volatile here, but the wave was flat 3 o'clock. It was an accumulation cycle on this 3-hour chart. And actually we had an accumulation, or have an accumulation, on the 240 as well. Okay, so within the context of overall a pretty steep downtrend on the daily chart, I have no setup here at all on the daily. Clock angle is great. Prices are moving down, but I need to actually trigger a setup. Well, the short trigger happened on the 3-hour chart, on the 180-minute chart. We broke the support of the uptrend line with a negative MACD. So what are the steps here? I recognize the sideways wave. I realize that I'm dealing with a accumulation market. And within the context of an accumulation market, I'm going to play breakout and breakdowns. If you are a breakout and breakdown trader, you should be looking for these 3 o'clock markets. Because it's from these 3 o'clock markets that you will see this coiled spring that gets squeezed into this sideways range, eventually spring. That's what happened here. It sprung. And it sprung down through the support of the uptrend line. The confirmation here was a negative MACD. And if any of you join me with any kind of regularity during my chats, you've seen this at work before. This should not be new. And if you haven't before, well, join me for the next chat. We do this over and over and over again every single week. Okay? So, taking a look here at this breakdown, that's what I'm looking at here, the breakdown through support. So again, I was not a breakout breakdown trader because I just felt like applying it. This is what the market required me to do based upon the underlying market cycle. Now, the 2 to 4 o'clock market cycle I spoke about earlier is aggressive. It's not one that I use a lot. Okay? But what we look for, and I'm not sure that we have one right now, but what we look for are solid support levels that will allow us to basically short resistance or buy support. And you know what I'll do? What I'll do as a follow-up to this half of our discussion here, over at the Chartology blog, and let me give you the link one more time, because this is the best way for you to keep in touch with me. So it's head over to blogs.fxstreet.com/Chartology. Okay, or you can also check out my personal blog at RagheeHorner.com. And I'll post some examples. And there's plenty of video. By the way, there's probably upwards of 24 videos at the Chartology blog that you can check out, because we record the Tuesday sessions and post them there. That's one way you can see these at work. So gang, those are the entries. Pretty simple, right? The basis for how you enter the market must come from understanding the whens. Okay? And because most of the highly correlated pairs have a relationship, most of the pairs that we trade have a high correlation back to the US dollar. That's why that overlap between London and New York becomes so important. Again, we talked about those pairs: Euro, US dollar, cable, Swissy, Canada, dollar, yen, Aussie, Kiwi. The one thing they all have in common is the US dollar. The US dollar is active and impacted most during the overlap between New York and London, 7 a.m. to noon. That does not mean that's the only time you can trade, but that does mean that's going to be usually the most active trading time. I hope that you can join me for my future FX Street chats here. Check out the Chartology blog. You can check out my personal blog at RagheeHorner.com. We'll be starting the second half of this presentation in, let's see, about a half an hour. Yes? And I believe you'll be able to check out this transcript here at the site later on. So, about 25 minutes. Okay, so I'll see you back in about 25. And again, thank you. Thank you for your time. I appreciate it. I hope this was something that will allow you to go back to your strategies right now and start to make some of those really huge distinctions as to when trading, when you're trading, which market cycles you're trading. Just apply the strategies you have even right now with those considerations. It will make a huge difference. Okay? If you have any questions, post them at my blog. I'll be more than happy to take a look. Have a wonderful day. Premium members, I'll see you in about 25 minutes, and we'll continue the discussion.